What's up everyone, welcome back to another video with the Millennial Finance. It's that time again. StashAway is doing another re-optimization. It seems like they usually do this when they see major trends happening. Last year it was the pandemic. This year it seems like it's an inflationary trend that we're seeing post the pandemic. So I'm going to start this video with telling you guys about the results from their last re-op in May 2020. We actually have a video about that, so I'm interested to see what our thoughts were back then and how it panned out. I said that it's very bold of StashAway to change from the US and European stocks to a more China heavy one. Since their re-optimization in May of 2020, US tech has increased by more than 50%, the European tech has increased by around 40%, and Chinese tech is nearly flat. I'm not saying that I'm a genius, it's a lot about timing. At one point, the Chinese tech ETF was up around 100%. This was around February this year. But it has since came crashing back down, and there's just a lot of regulatory risk regarding Chinese stocks right now. At that point, I also said that I didn't like the gold allocation. They increased it from 0 to 20%, and ever since then, gold has stayed essentially flat. I was wrong on REITs though. They did include REITs at the time. I thought that people wouldn't really want real estate anymore. Of course, back then it was the height of lockdowns and everything like that, but REITs has really outperformed, especially this year. Overall though, I'd say that StashAway's portfolio performance was acceptable, considering that it was so diversified, and we're speaking about all of this in hindsight. The market could have acted very differently. Maybe we wouldn't be on a massive bull run right now, and if the markets corrected instead, then I'm sure that StashAway's portfolios would have been better than mine. But at this point right now, we have to acknowledge that their portfolio actually is underperforming the US ETFs. This time around, they sent all of us an email. I got it as well. So they said that they're optimizing it for inflation in the US and disinflationary growth for non-US equities. In this video, I'll be talking specifically about the 36% portfolio because this is the one that I currently have with StashAway. But I think that the changes that are being made in this portfolio also reflects the other one, just to different degrees, but I guess it's fine. At first glance, looking at this new portfolio, I'd say that this is really against what I personally invest in my own stock portfolio. On a high level, they reduced US equity and commodities, they've added to real estate, they introduced corporate bonds, and they have maintained their international equities exposure. To start things off, let's talk about the non-equity assets, which are bonds, commodities, and REITs. The reason I lump all three of these assets together is because, first of all, they're of course non-stocks, they're not the usual stocks that we invest in. And second of all, they're generally low risk, low return kind of investments. Now, between these three assets, I have about 33% of my highest risk portfolio in them. Like I said, these are more of low risk, low reward kind of plays. While I have nothing against the choices themselves, for example, I don't care whether it's US REITs or global REITs, I really wonder why such a high percentage of my very aggressive portfolio is in them. In my mind at least, very aggressive would mean, 85-90% in stocks and the rest in maybe bonds or whatever else. I know that if you see a market correction in stocks, if 85-90% of my portfolio is in them, I would see a very big drawdown. But then again, I understood this risk when I chose the 36% risk portfolio anyway. In my 26% risk portfolio, which to me, I still think is, or it should be considered quite aggressive, it's even worse. Now, nearly 60% of all my investments are in these three assets. This shows me that StashAway is extremely risk averse, and even the highest risk portfolio that they have available to all of us, it resembles more of a balanced portfolio than a very aggressive one. This is good for people with a lot of money already. Maybe they're slightly older, they want to preserve capital, they follow the 60-40 stock bond allocation. But for people like us millennials who are young and just starting out our career, I believe that a very high allocation to stocks, even though it could be risky, is very much justified. This means that if we have a very strong bull market in stocks, we would 100% underperform the US ETFs like the S&P 500 or the Nasdaq. My guess is that they could be doing this because they think stocks have had a run too far since March of last year, and they think they'll hit down lower, which is why they're starting to put more and more of the portfolio into these non-equity allocations. However, to me, this is just a bit too much, and I might actually move my entire 26% portfolio to 36% because this is not why I invested in StashAway for. Moving on to the equity assets. So what they did was they reduced US equities yet again They did it the last time, I questioned it, now they're doing it again, and they're keeping their allocation to international equities. I don't really know how I feel about this, but let's start the analysis on international stocks. So in terms of breakdown, they're going to maintain Chinese tech as the core of all of this. I know that a lot of you guys probably don't like this. For people who started investing in StashAway in around January, February or March of this year, you can probably see that your Chinese tech ETF is probably down around 30-40%. Like I said, there's a lot of risk in Chinese tech right now. The government or the CCP is really clamping down on them. For example, the Ant Financial IPO. I actually made a video. I was so excited about Ant Financial IPO. You guys can check it out. It has almost no views because at the end of the day, they weren't allowed to IPO, so it didn't even happen. So the more recent one that probably scared investors is the DD Global IPO. They're the equivalent of Grab and Uber in China, so they do ride hailing, livery and all of that. And yeah, they recently IPO'd and China, the government got so angry that they removed the DD app from their app store. This caused the stock to tank. I think it's down now 50% since its IPO and they only did it less than a month ago. So that's a very bad sign. Any investor who put it in thinking that it would go up is now facing a very large drawdown. As a result of all of this, a lot of foreign investors are now starting to lose faith in these Chinese companies, and people even like myself, I'm starting to wonder, like, if I have so many choices for places to invest my money in, why would I choose China when there's such a high geopolitical risk where every other country doesn't? One thing I must say though, that especially now, these Chinese companies are extremely undervalued compared to the US or European peers. So this is one thing that they have going for them. This to me can go either way. I personally at this point don't mind this allocation at all. These are very, very good companies and they're at great prices. So having a bit of a portfolio in it has no harm. Even though they're great companies and they're very cheap right now, like I said, because of all the regulatory uncertainty, the stock price may not reflect that. StashAway definitely thinks it will in the near term, so let's see. What was more surprising than this to me though was the inclusion of the Australian ETF, which has replaced the other emerging markets in Asia. I have no views on Australia as I don't know it very well. I've been there on holiday, but other than that, I don't really know their companies other than one of them named Afterpay. I guess it's less that I don't like Australia and more that I really like the emerging markets ETF. They gave me a lot of exposures to different countries like Taiwan, India, and even a bit of Singapore and Malaysia. This diversity of having stocks from so many different countries is now all being replaced with just one being Australia. That's not such a big deal if you have a lot of conviction in Australian stocks, but like I said, I don't really know them. And looking at a quick glance of the ETF stock holdings, it looks like most of it are in the mining or financial industries. These aren't my favorite industries. I don't really know how they'll perform in the future. All I know that recently, some of these mining companies have actually went up by a lot. We'll just have to wait and see about how the future performance will be. Finally, we'll be talking about their US stocks. So here, they removed consumer discretionary and healthcare and replaced it with consumer staples and energy. Personally, I really liked both healthcare and consumer discretionary before this. They've both performed extremely well over the last 1.5 years, and they have great companies in them like Amazon, Tesla, Nike, and Johnson & Johnson. If you guys are wondering what consumer discretionary means, it's basically companies that sell product that is not really a necessity to us, but it's more of things that we want. For example, Tesla and Nike, their cars and shoes are not really things that we need, but we might want to buy them if you have some extra cash. On the other hand, they're now replacing this and changing it to consumer staples, which by its name means that these companies sell products that we need from a day-to-day basis. So maybe stuff like toilet paper, toothbrush, soap, or shampoo. So examples of these companies that are in this ETF right now is Procter & Gamble or Walmart. This is in line with their theory of inflation for US because in times of inflation, consumer staple stocks will perform well. Honestly, I don't mind this allocation. Consumer staples, I also have a feeling will go up in the short to medium term. So this isn't really a big deal for me. Let me tell you what's a big deal for me. I don't know if you guys would have guessed it already, but I cannot believe that they are putting back their allocation into energy. In their last re-optimization, they removed the energy ETF. I was so happy. I didn't really like the ETF at all. And now they seem to have completely reversed the decision and put it back in. These energy stocks are basically oil and gas companies. They've already had a big run up since at the end of last year, you guys can take a look at the charts of this ETF or the stocks and you can see it. As the economy starts to reopen, people found vaccinations, investors already knew that there would be an increase in demand for oil and gas, so investors already bought up all these stocks. So at this point right now, it is close to where it was pre the pandemic, and I don't see where we're going to find new growth for this sector. Another thing about this sector is that as a millennial, I would never consider investing in these oil and gas companies. I would much rather, if StashAway thinks that energy will be a big thing, that they put it into something like a clean energy portfolio. So maybe companies that are selling energy through solar or wind. These things actually have massive tailwinds, especially in the US, because Joe Biden, his entire team is really looking towards this, and there'll be big infrastructure bills that could benefit these companies. I could be very wrong. Maybe StashAway sees something in oil and gas that they don't see in clean energy or anything else. It could definitely continue its bull run, but in my opinion, this feels more like a trade than a long-term investment. If you look at the top holdings of this ETF, it's 45% in just two stocks, which is Chevron and ExxonMobil. These are very legacy oil and gas companies. Yes, they're huge. Exxon used to be the biggest company in the world, but in 2021, these are just not companies that I'm very excited to invest my money in. So, after looking at all the changes of my 36% risk portfolio, I would have to come to the conclusion that I would rather keep my old portfolio than this new one. StashAway has also recently announced a few weeks back that they will no longer allow users to decide whether they want the re-optimization or not. Instead, now all of us will have our portfolios automatically re-optimized whether we want to or not. I hope that this decision by StashAway doesn't cost me my second Lamborghini when I'm 50 years old. I'm really saving up. I already have 5,000 in there, and in just 30 years, I'm sure that this will become 2 million. So StashAway, please, I'm hoping you guys are making the right decisions. However, having said all of this, I'll have to say that I'm going to keep my money in StashAway and I will continue my monthly deposits. There are two main reasons for this. The first one is that I'm just a guy on YouTube who does all of this as a hobby. And those guys at StashAway who are deciding our portfolios, they're professional investors. They probably spend 10 times more time than me looking at the market, looking at economic conditions, and their decisions could turn out great. I'm not going to be arrogant even though I have outperformed them in the last 1 year. I know for sure that this probably won't continue into the next 5-10 years. I'm going to give them the benefit of the doubt for now, even though our investment thesis don't align, and it wouldn't hurt, I guess, having just a portion of my investment portfolio in StashAway. It's not like I have all my money in StashAway anyway. The second reason that I'm going to keep my money and in fact continue adding to it is because in my own stock portfolio, which has a much higher value than what I have in StashAway, I'm already very heavily weighted towards the growth tech stocks, which I know for sure if inflation is really going to ramp up in the US, these stocks will take a beating. I really like these companies in my portfolio, so companies like Roku, C Limited, Shopify. I know that if inflation really starts to tick up, they will take a beating, but I don't really want to sell them because I like the companies for the long term. So having this part of my portfolio in StashAway and it being an inverse to what my own stock portfolio is, it actually provides me some sort of a cushion if inflation really kicks in and my own stock portfolio starts to bleed. Personally, of course, I would prefer if my own stock portfolio shoots up and StashAway just, slowly goes up because most of my money is in my own stock portfolio anyway. Let us know what you guys think about the StashAway Re-Optimization. Tell us down in the comments below, do you like it or not? If you guys want to sign up for StashAway, remember to use our link. We'll leave it in the description down below. You'll get 50% off for the first 6 months and we will get a bit of money so that one day I can buy my Lamborghini. Thanks for watching till the end. Give us a big thumbs up if you like this, subscribe to our channel if you haven't already, and see you guys in the next one. Peace out.